Should I speak now? Okay. Hello, good morning. This is Joshua here, the head of research. Welcome to our weekly market commentary and stock strategy. Okay, we're going to do this weekly from now on, every Monday. Hopefully, if this goes well, we'll continue it. And also, after this webinar is over, we'll still be here at BD office. Okay, so if you guys want to come down and mingle, we'll be here, and we hope to swap small cap ideas with you. Okay, so let's get started. We'll start with the STI Market Outlook, and then we'll go on to the Singapore equity strategy, which will be done by Derek. Oops. Okay, about 10 days ago in our morning note, on the 9th of November, we gave a heads up that a correction was about to come, and we have since lost 70 points. Okay, so this is the blurb from the morning note. We anticipated that that there will be a short-term, there will be a correction because the STI had already been a short-term downtrend. Okay, and we're inching towards the 3,000 support, and the 20 DMA went below the 50. And so odds on selling will pick up the pace, okay, and we recommended a short at the time. Okay, so far that has proved correct. So you see the decline over here, the decline. And on Friday, well, last week Friday, we ended with a failed piercing pattern. So actually there was a candlestick. Whoops, there was a candlestick that was attempting to rally, but it failed. So that's weakness suggested. Okay, but the U.S. actually closed well. Okay, and I'll go on to that later. Right now, 2,900 is a minor support, and the crucial line in the sand, as you can see, is the lower upward sloping trend line of the STI, which is about 2840. Okay. Okay, so this sell-off is largely due to the fiscal cliff. And the S&P 500 closed on Friday with a fairly positive hammer over here. All right, and this is due to a positive shift of tone in Washington, with the Republicans signaling a willingness for tax increases, which they never did before, and Obama to pair that with spending cuts. And Treasury Secretary Geithner is confident of a deal before Christmas, so we detect a distinct shift of tone. So yes, the S&P had a close to 0.5% rally, and you can see that long tail down there. All right. Okay, so we expect a positive bounce now, but the 200 daily moving averages to act as resistance because we're still lacking details. Okay, if there are no details, this will turn out to be a dead cat bounce. Okay, if you look back to the STI, the white line, that's the 200 moving average for the STI. Okay, the overall market tone is a little bearish for the fourth quarter of 2012. Commodities, oil are still in a bear market with lower highs. Okay, this is a key asset price signal, which is not signaling a return to strong global growth yet. I'll go through these in more detail later, but I'll just give you the logic so far. Okay, U.S. earnings have come in mixed to negative, especially in tech and industrials. U.S. macro data is pretty mixed. There's good points, bad points, and mixed points. The good is housing and labor. The mixed is that consumption has seen some gains, but it's half supported by savings. And the bad is basically new investment orders is negative. Okay, U.S. fiscal cliff uncertainty is certainly killing investment sentiment, which is a key driver for future growth. And Asian macro data is still poor. However, we are actually constructive and hopeful going into 2013. Although Asian macro data is not great, we do note that the rate of contraction is decelerating. Hopefully, a U.S. fiscal cliff resolution will cause new orders for capex to reverse course. And China is actually looking up with growth stabilizing. And the new leaders may actually spearhead confidence-boosting reforms. Okay, and actually third quarter STI earnings actually came in even. All right, they started off a bit wobbly, but I think we've ended in line with expectations earnings session. Okay, just to go through what I've the logic of what I've just said. Okay, you can see all the major commodity markets here in downtrends. That's a downtrend, down, all the lower highs here. Okay, for the top left chart is general commodities. Then the one below it is energy, and then the one on the top right is industrials. The one on the bottom is agriculture. Okay, a series of lower highs. Now for the U.S., what's been good is housing. Housing starts have been strong. U.S. non-farm payrolls have been okay, not fantastic, but chugging along with a job expansion that is, I think, about 175,000 a month, which is all right. Retail sales, as we said, was mixed, so we saw a flick up in retail sales, but that's mainly due to the savings rate coming down. Okay, this is the downright bad, which is new core capex orders, which actually backtests very well with previous recessions. So you can see here in 01, 02, recession, new investment orders was severely down, and also in the last crisis. And now we see it again firmly in negative territory. So we want to see this reverse, okay? Because it's actually a very, has been proven to be a good, reliable indicator for a weak economy, okay? And we're hoping that the fiscal cliff will reverse the situation. Now, industrialized Asia's export data is negative, but we note that the rate of contraction is easing. So if you look at South Korea, we have seen that the rate of contraction is easing. For Taiwan, it's actually gone back to positive. Japan machine tool orders flat and easing. China's exports easing. Okay, and for Singapore's industrial production as well, we see that the rate of contraction is recovering. Okay. So these are very, very green shoots that could easily wilt, but we have reason to be hopeful. That is, China is stabilizing, and we hope that reform. Well, we think reform is in the air, and that could be a catalyst for confidence. Right. Okay. For China's retail sales, yeah, we have seen a stabilization. Fixed asset investment has seen a stabilization. Loan growth is coming back, and industrial profit rate of contraction is stabilizing. Okay, on balance, we note a distinct shift of tone in Washington, which makes us optimistic that we'll actually get a deal. The U.S. presidential elections are actually seen as a defeat of the extreme right-wing Tea Party elements of the Republican Party. So we could see a return of the party to more of the center, and that gives a better chance of a deal. Okay, so we're hopeful. A resolution of the cliff would reverse new orders for capital goods, which is the main holdout for U.S. indicators. Eurozone is facing continued recession, but a resurgent U.S. and China is possible. ASEAN countries continue to post robust domestic demand on public infrastructure spending. So we think if we get a deal on the fiscal cliff, there's more upside for the STI. But till then, I think there are certainly downside pressures. Thanks. Okay, I'll move you guys over to Derek right now, who will talk about the results season and what will outperform. Thanks.
Hello, hi, this is Derek here speaking. Those of you who know me would probably remember me as the transport analyst for our team, but going forward, I will be covering the Singapore equity strategies as well. Today, I'll talk about the results season review and what we think could actually outperform in the near term. First, these are the list of items that we'll go through today. First of which, I'll start off with the upgrades and downgrades in this results season and what could outperform. And we also aim to highlight feature a company under our coverage every week in order to help everyone understand our coverage better. At the end, I also attached two comparable table on the PSR coverage as well as the STI component valuations. Because I added in also because I know that not everyone is really familiar with all the companies under our coverage. So that could be a quick guide. So let's start off now. We have 6 upgrades and 2 downgrades in this results season. First of which, we upgraded SATS to accumulate rating. with a target price of 294, largely due to earnings that beat our estimates, and we expect dividends for this company to actually grow as they continue to optimize their capital structure. The next company that we upgraded is actually NOL, from neutral to accumulate, largely due to improving unit cost and the disposal of non-core assets that actually free up quite a bit of capital for the company. The next one is Parkway Life REIT. It's actually a defensive REIT, and we think that there's a good inflation hedge that is built into its rental structure. Our analyst Travis actually think that there is a potential for further yield compression going forward. We also upgraded M1 from reduced to neutral, largely because of the fiber potential and still fairly attractive yield on this stock. We also upgraded UOB from neutral to accumulate, largely due to cheaper valuations on the stock. The company's fundamentals are also very strong, and we expect higher contribution from its regional offices. The last one that we upgraded recently in our results season is the Wilmar International from neutral to accumulate, largely due to upward revisions to the earnings and upward revisions to our target price as a result of the earnings revision. We downgraded CMA. Capital Malls Asia, we remain positive on the stock actually, but we downgraded our recommendation from buy to accumulate as we see less upside on the stock. But if you have actually followed Brian, our property analyst call since the start of the year, you have been in on the top performing STI stock for the year, which is up around 58% year to date. With this strong rally, we think the upside is a little bit more limited, so the conviction call is not as high. So it's from buy to accumulate, but we still have a positive view on stock. We downgraded Sabana REIT, this very interesting Sharia compliant REIT, from positive view to neutral, largely due to fairly rich valuations that could limit upside. But we still see them as a stock as having attractive yields, hence the neutral recommendation. So what do we think can outperform the near term? We have three stocks that we like to feature today. The first of which is Capital Land. We have accumulate rating, target price of 355. Macro view, our macro team actually thinks that China have actually bottomed out. And so far, the data points that we have observed on the property price index as the increase in the property prices in China is fairly tame. September, we see only 12 out of 70 cities having yearly increase in the new home prices. For the latest October data is also fairly alright. The number of homes showing increase also is not that high. Capital Land offers a significant exposure to this bottoming out in China's property market, with around 38% of its properties asset allocation exposure to China. And it's still trading at a reasonable price, discount to our analyst RNAV, and the target price of 355. SETS is the second company that we actually highlight today. It's a dominant ground handling company with in-flight catering business in Changi Airport. And as I mentioned earlier on, we expect the company to actually optimize its capital structure over the next few years, and hence they could actually grow its core dividends over the next few years. Yields are still fairly attractive at today's price, worth taking a look at this company. The last company that we highlight today, STI Engineering. We have a buy recommendation and a target price of $5. This is a company that will feature in our presentation today. So now, let me just take some time to go through our featured company, STI Engineering. They are a provider of MRO services, maintenance, repair, and overhaul services for commercial airlines. They have two broad business segments: line maintenance and technical ground handling. This is the one that contributes around 34% of its sales, but a fairly profitable business segment, which contributes more in the operating profit line. The next one is the repair and overhaul business, which comprises of airframe maintenance as well as the fleet maintenance business. When we look at this company, let me just highlight that you should really take a look at the joint ventures as well. You look at the bottom right-hand chart on this page, you will see the EBIT contribution from various businesses. Notice that the core company itself contributes less than half of the profits to this company, but the rest of which is actually contributed by its joint ventures, which is really an explicit strategy of growth that is by the management to actually grow the business beyond its core company. Well, the key investment merits, they are an excellent proxy play to the tourism growth in Singapore, as the line maintenance business benefits directly from freight traffic in Singapore. And through its joint ventures and associates, it benefits from the Asia-Pac aviation growth story in this region. And of course, being a subsidiary of Singapore Airlines, it enjoys a stable base load. And lastly, successful strategy of growth through its joint ventures. Alright, I guess there was a slight blip there. The audio connection was off. Now it's back up. Hope everyone can hear me. Some recent developments for this company. You might have heard that SIA actually announced a record order for new aircrafts. As you can see in this slide, a summary of these aircrafts on orders. Quite a significant and aggressive strategy by the SIA group actually. Singapore Airlines currently have around 100 planes, but they're ordering quite a number of wide-body aircrafts. Silk Air has 22 aircrafts now, and they have announced record orders for a large fleet of Boeing 737 and a couple of A320s left on this order book, largely to take advantage of the regional growth in the short-haul market. And Scoot, the latest venture by Singapore Airlines to the low-cost carrier business, actually ordered another 20 Boeing 787 as compared to the 4 aircrafts that will be in the fleet now. Well, what's the impact on SI Engineering? We expect SI Engineering to actually develop the fleet maintenance program for its Boeing 737 series. With that, they can actually grow the business beyond the current A320 series of aircrafts on its fleet maintenance program. And of course, naturally, with capacity growth, there will be increase in demand for maintenance work across all kinds of maintenance business segment. Well, the second point brings us to the engine orders for Rolls-Royce. SIA, at the same time as the announcement of orders for new aircraft, they actually announced that they ordered another $2.6 billion of Trent engines from Rolls-Royce. This follows from a previous order of around $1 billion of orders for 15 A330s engines. That is the Trent 700 series of engine. That was in June 2011. Hence, with that, we think that how SI Engineering also benefit from this trend. SI Engineering has a 50% joint venture with Rolls-Royce called SASO, which is actually which would actually benefit from the large number of Rolls-Royce engines ordered. As you can see, A330s, A350s, A380s are all powered by a Trent series of engines, which SASO actually has a very strong moat in its maintenance services within the region. We can talk about that if you are interested in more detail. Well, going forward, the upside could come from 787 engines, aircraft actually. 787 aircraft ordered by Scoot have not been announced their engine orders yet. But one possible engine order is Trent for 1,000 excellent business and through aviation growth story in this region. So the third point is that they are expanding into Philippines, and the company actually announced their intention for a 7th hangar. They actually form a joint venture with Cebu Pacific, one of the fastest growing low-cost carriers in the region, for 3 hangars. And recently we met up with the management, and they have highlighted they are considering building a 7th hangar in Singapore. Currently they have 6. The 7th one is in the planning. So with that, they could actually tap into lower cost base in Philippines, and with the increased airframe capacity, revenue could grow as well. So this is my last slide on this company actually. We think that you should watch this company for its free cash flows. And what we think is not so appreciated by the markets is the joint venture companies. The free cash flow generating nature of this company actually allows the company to pay cash payouts to the shareholders in the form of dividends. And there's also insignificant debt on its balance sheet. So do keep a lookout for that. The joint ventures are also maturing after announcing various capacity expansion plan. I think I've talked quite a bit about Hazel. Hazel, they own 10% stake, also did some expansion in 2011. And you might have heard in the news that Rolls-Royce actually it has just launched their new engine manufacturing plant in Singapore. We think that this is actually a testament of the growing demand for this Trent series of engines in this region. So that's positive for this joint ventures as well. So we have come to the end of our presentation. These are some of the comparable companies. These are the companies that we actually cover from commodities, consumer goods, banking, properties companies, REITs, and industrials, and finally the telcos. And I've also attached a couple of slides for the STI components comparable charts that you can take a look at. So now we have reached the end of the seminar. We will take some questions. Thank you for joining us today. We'll answer your questions now. How do we see the questions? Do you have any questions? No questions? Okay, it seems like there are no questions on the queue now. Anyone interested could just post some questions. Or you could just drop by here at the BD corner and we can discuss more. Any questions? Yeah, so no, it's a bit, it's the enter tree. Okay, if don't have, then we just. Well, I guess maybe not everyone is very familiar with how to enter questions. Okay. Sorry, we have one question now. We recommend M1, but the target price is 241. Let me pass that to Ken to answer this question, please.
Hi, for M1, our call is on neutral. Yeah, the target price is actually currently below its current trading price. However, due to the dividend, high attractive dividend yield, we think that share price would be stable and therefore a neutral rating. Hope this clarifies.
Okay, that's Ken with the question. How do you open that?
Can you send the slides?
You click on the can you
Click here, is it? Can you send the slides? Yes.
Okay, so we also have a question to ask for the slides. Yes, we can do that. We can send the recorded webinar or the slides at least to the trading reps, no problem. Or you could just drop us a mail. We can send that to you as well. Let's see what other questions do we have.
That's it.
All right. I guess there are no more questions in the queue. So thank you for attending our seminar today. We hope to join you. Hope that you can join us next time. So we hope to make this a weekly event. We are now at the BD corner, so do join us for some refreshments, and we can take our discussions further from here. Thank you very much.